So if you think about your entire universe of all investable securities and you start measuring them against a benchmark. So let's just start by asset class. Are commodities, US treasuries, US equities, or cryptos, or just holding US dollar cash? What's performing the best out of those asset classes?
Been using trade ideas since 2006, worked in the hedge fund space for 10 years, and this is what Tyler was speaking about earlier. I, from then, became an algorithmic day and swing trader. So using a combination of charting and traditional technical analysis, again, with quantitative metrics and approaches and everything like that. So my path to the CMT may be a little bit different than most, as someone who spent so much time staring at charts for as long as I have. But a couple things that I really have gained from it and enjoyed about it, even someone with my experience, was the pulling out of your comfort zone slightly. The fact that I was able to look at things and learn things that were in my field of study, but I had never touched. So, and again, that gave the inspiration to what I'm going to talk about now, which is the new product that Trade Ideas came out. So it was very cool. Again, I would recommend anyone doing it regardless of experience. They start you off in such a way that you don't need to be as obsessed with the market as I have been for so long, and you still get a good on-ramp. Again, simply because as traders, we get stuck in our rut. We look at the market the same way that we've always looked at the market, whether that's the most optimal way to take a look at it or not. There is a certain prestige, I guess, for lack of a better term, to the designation when simple things. When I'm looking at different people talking about their trades and their charts on Twitter or something like that, I personally look and perk up when I see that CMT designation, because I know, okay, at least this is someone who has done some amount of work and for me, it took 2.5, 3 years to complete and many hours of study. So we're going to talk about relative strength and the TI strength alerts that we have built from here. And this is just a concept. I'm not going to spend too much time on the wordies, but I found it from Michael Moody, CMT, just talking about the concept of relative strength, which is essentially just looking at assets that are outperforming other assets. Right? Where is the money flowing into as opposed to where the money is flowing out of? And as Tyler mentioned with his graph of all the momentum and strength names, tons of different studies that you can take a look at. But I'm a simple man, so I like to boil things down simply. So what are the benefits of relative strength? Right? So just simply what we're talking about when it comes to relative strength is comparing a instrument to a similar instrument. So a stock to the overall benchmark of the market, or even a stock just relative to itself. So there's just a snapshot I grabbed of Google and Apple. It's kind of very easy to see here that Google, we are outperforming at this time over Apple. So if someone were to want to deploy capital into a market like this, Google and Apple both build operating systems for phones. They're both, mobile producers involved in search and web building and things like that. You could say, from a relative strength point of view, that in this instance, Google has more money flowing into it, pushing it higher than Apple would. So one of the main benefits of a relative strength approach, and this is where I think a lot of the outperformance comes from, and this is the concept that we're pushing with the TI strength, is that when the market is tanking, these relative names don't tank as much. So I grabbed a snapshot here of the pandemic kind of sell-off, and you can see the SPY, the S&P 500, just falling off a cliff, whereas stocks like Zoom, Peloton, and Netflix were holding on. Now, some people may say, well, that's because of the fundamental story and what they do, and they'd be correct, but how to spot it is a different thing. We could simply take a look at it and say, well, as this thing is selling from March until April, Zoom's holding on strong. So as opposed to having to look at the study and study the different names and why they react the way they do, you can simply take a look at these relative charts versus each other. And here's a section where the market is rallying. Again, the S&P 500 being a basket of 500 names. you can then go and say, hey, well, I'm going to focus more on the ones that are really outperforming. So Tesla here obviously has been outperforming the S&P 500 for the past year or so. We want to go a little deeper than that because, as we know, if something runs too far and too fast, it can, maybe pull back or give a little bit of correction before it goes. So we want to try to improve these results to hopefully smooth out an equity curve and to make trading just a little bit more fun. Those pullbacks are certainly not fun. So what we've done when we were building this relative strength model is I looked at, and I'll talk about in a bit, the teachings that I got from the CMT in order to help me build this. But we started to add studies to a relative strength model, looking for things that were strong, but then also saying, I want to make sure that XYZ is not occurring. For example, Peloton, all throughout this chart, is performing very well versus the SPY. But you can see when we're outside of the Bollinger Bands after this big long run, that wouldn't have been the best time to initiate a transaction. So just little things that we can do to help try to increase performance. The same thing with chart patterns. A concept of HTGC, which is one of the stocks that we actually gave to the TI Strength members. You can see the performance of it. The kind of 45-degree angle up. However, we're trying to figure out when the best time is to participate in these trends. So step one is identifying these trends, and then step two is making sure that we're participating at the right time, also that we can use these metrics to make sure we're limiting our risk. So here's how we created our model. So it was CMT, I believe, and Tyler, I'm sure will correct me, CMT level 2, where they talk most about Ned Davis and his Fab 5 ranking system. So it was a systematic approach in which he was able to go through and say, I am able to look at these 5 factors and then use a weight of the evidence approach with these 5 factors in order to make a decision when to participate and when not to participate in the market. So while I was building this, using the concept of relative strength that I talked about, we grabbed from our own little Trade Ideas community different indicators, candlestick patterns, chart patterns that they believed was inducive of strength, right? So step one, take things that are stronger than the rest of the market. Step two, apply these different indicators and chart patterns and candlestick patterns to make sure that we're focused on exactly what we consider strong based off of all of these different ranking systems. And then we gave a weight to them. So some simple examples would be, as Tyler showed with that one chart of the 50 period moving average and the 200 period moving average. We would say something like, if the 50 period and if the 50 period is over the 200 period and both are sloping upwards, well, we'll give this stock 10 points. And if it's put in a bunch of hammer candles recently, which is something that we also think is a sign of strength, we may give it another 10 points. And then we rank these stocks by these weights, and this is every stock in the market, and then provide to our clients the top 5 of those. And this is just the performance of this versus the market going back 2017 to date, using something else that I learned in the CMT. There's a lot of focus on making sure that you're back testing and that the way you're testing and the way you're modeling systems is kind of truthful and honest, to make sure that whenever you employ something, you employ it correctly, and that you haven't just created something that in theory works on paper but doesn't actually translate to the real world. So if there's some other CMTs out there, I use the walk forward testing the way they mentioned. I made sure not to optimize. I built a system and I tested it for a period of time, and then I walked forward that test to date. And then we did forward testing, which is just testing in real time for about a year after that to make sure that it was holding up in the real market on top of that. Again, all great things that you can learn with the CMT for sure. So here's just some examples that I'll get into. One is CYH, which if you guys look at your charts right now is way better than even when I took this picture yesterday afternoon. So what you get in the email is this on the left that has my philosophy, like what I see when I look at the chart. I draw some lines for you guys of support and resistance, show you where those next levels are, and then you get a bit of understanding of what the industry it's in again, analysis of sectors and industries are very important. And again, this is, I think we're over 15 on this one now, but you can see the drawing as it was sent to you, and then this is kind of what occurred after that. That's one. And of course, they will not all be like this. We're looking at the ones that are looking the coolest right now. This one is a combination of technical, and then I actually put in a little bit of a fundamental aspect here, talking about short squeezes. But this one, again, is another concept. You can see that going into when it was alerted to you, it was not only a relatively strong stock, but a relatively strong stock putting in this formation, something that we look at. Again, the CMT, they actually go and they break down the statistics behind all of these, so you can see how many times they revisit the entry price. You can see how many times they break out and move, success rates of patterns, that type of thing. And then that was actually, you have to zoom in to see it, but that was actually on this candle right here, and then chop sideways for a little bit, and then off to the races. Oh, there we are. We're back.
We're back.
Well done, Michael. Hey, we had a couple of questions come in for you, Mike. One was from, I apologize if I'm butchering the name, Nippon. He wrote, so relative strength is acting as a filter and price action is used for entry. Is that correct?
Both are actually used as a filter. So the core concept of this is that we always want to be looking at where the money is flowing into. And so the example of Zoom during the pandemic crash, I think, is a perfect one. Everybody was dumping everything except Zoom, Peloton, Netflix, all the names that we know. So the main core concept is looking for the things that are outperforming not just the market, but outperforming every other stock in the market, and that's one of the main benefits that Trade Ideas has, is we have massive server tech that can crunch all this math. But then with the price action and everything, that is into it. So if you look at it as, I'm going to take the world of everything that's relatively strong compared to the market, and I'm going to narrow that down by things that, for example, are not overbought based off of your typical oscillators, RSIs, and things, and Bollinger Bands, things like this. I'm also going to make sure that they're forming some sort of technical pattern, have broken out of some sort of technical pattern that makes sense as well. So it's all part of the filtering mechanism. And what we've really done is, again, of all of the relatively strong stocks, we've given a lot of value to things that have just cleared or just broken out of some sort of technical pattern.
Awesome. And on that topic of relative strength, we had another question come in from Matt. He just wanted to know what your thoughts are on relative strength versus the SPX, like you described, versus relative strength versus the rest of the individual stocks, something like an IBD relative strength rating.
It's probably going to be the same in a lot of cases, and I would think so, yeah. Because the S&P 500 is going to incorporate a lot of stocks. So one thing we're seeing in the market right now is the S&P 500 keeps making all-time highs, and we're hearing a lot of people saying, well, my portfolio is not making all-time highs, and that's generally because you're invested in growth names that we know are underperforming right now. So the ability to say, the S&P, I guess the long and short of it, is just a collection of 500 stocks. So if you're outperforming the S&P, you're probably outperforming those 500 stocks. You're better to go on a stock-by-stock basis, but that takes a lot of math and server tech and that type of thing.
If I could add just a couple comments to that as well. So a lot of the sell-side research analysts are going to take a top-down approach. Or if you read anybody's macro research, they're using a lot of the writings of John Murphy to understand what's happening between asset classes, or they're looking at intermarket relationships. So if you think about your entire universe of all investable securities, and you start measuring them against a benchmark. So let's just start by asset class. Are commodities, U.S. treasuries, U.S. equities, or cryptos, or just holding U.S. dollar cash? What's performing the best out of those asset classes? You come to the conclusion that commodities and equities and cryptocurrencies are doing the best, right? We don't want to be buying U.S. treasuries. We don't just want to be all cash. And I'm talking about this period post-COVID collapse, right? Starting from April last year. Now, if you just take the equity basket, you could start looking at each of the sectors to the whole index and compare what sectors are outperforming the S&P, what's driving things higher. Well, that rotation, the concept of investors putting their money to work in different sectors of the economy, really took root, and I think challenged a lot of folks through the end of the first quarter and into where we are right now, where you saw banks energy stocks, a lot more cyclical and value sectors of the index starting to outperform on a relative basis. I saw just today some gold bugs and even Bloomberg News commenting on the fact that gold on a relative basis to Bitcoin was starting to turn up, right? That could be a short-term thing. It doesn't mean that this is the end of all digital currencies, and it doesn't mean that we should be flocking to gold, which has been an underperformer since the end of the collapse last spring. So the tool is very powerful, but just like a doctor with a scalpel, you want to make sure that that doctor knows what they're doing. So relative strength is a really important comparative tool in the technical toolkit.
If you just ranked all stocks by which are performing better, those crazy ones are performing better. But I'm not going to buy something. I'm sure I could grab a name out of the hat right now. The trade du jour, that thing that just rocketed, a thousandfold. Well, technically, it's performing better than everything else, but that's not where you want to go. So you need to focus on some way to filter those out so that you're performing, or you're looking at the things that are performing the best over time, as opposed to in these kind of short bursts as they pop into favor.